All right, everybody, welcome back to the RichMind podcast. And today is another episode in the series of episodes, and we're going to see how many episodes or series of that we kind of add to this series here. We're talking about the stock market. We're talking about investing in stocks, single stocks, not in mutual funds, not in the normal 401k, the things that we are really brought up to believe is the only way to invest in the stock market. And I've got with me again today an expert in the field of the stock market, Joel Solomon. He's an ex-hedge fund manager. The previous episode, go back and I gave you a few minutes of all the bullet lists of exactly everything he's done. But let's just put it this way. He's very experienced when it comes to selecting stocks, finding winners, just doing all the things necessary to generate money and wealth in the stock market, which is why I'm super excited about to continue on with this conversation. So I'm going to turn it over to Joel. He's going to go a little bit deeper about the conversation we talked about, but then go a little bit deeper into the next portion of the subject. So Joel, welcome back to the show. And I'm looking forward to this next round of conversation here.
Thanks so much, Randy. Again, it's a great honor to be here. I appreciate you so much. So just quickly, many of you know I'm a prosperity coach, but I am a former hedge fund manager. I managed $700 million at Citi. I made money in 2008 when the market was down 40%. Financial stocks were down 57%. Those were the only stocks I was managing. And we managed to make a little bit of money that year. I might actually still be at Citi if a law wasn't passed that said banks can't own hedge funds. So my whole division was laid off, which gave me the kick in the butt to start my own fund. So as Randy mentioned in the last episode, I did start my own hedge fund, launched and raised money, went through that whole process. And as we talked about last time, a hedge fund is just when, at least my hedge fund was, we were betting some stocks were going to go up, other stocks were going to go down, so we were hedged. So I have a little bit of experience managing large amounts of money of my own and investors and Citigroup shareholders, deposit holders' money. And last time we talked about what the stock market was all about. We talked about the balance sheet, and on the balance sheet and Apple, we went through Apple's balance sheet and we'll go through Apple's income statement as well. We talked about the assets, the investments that Apple had, which was very interesting because most people think of Apple as a technology company, and yet their balance sheet is composed mostly of cash and short-term investments and debt that they've issued because these companies, which are technology companies, they're very smart senior managers and know that it's smart to borrow money at low interest rates, and they did that when interest rates were much lower. And so we talked about assets and liabilities and equity, also known as the book value of the company. And we found that Apple a couple of years ago had book value or shareholders' equity 72 billion. The book value will calculate maybe this time, maybe next time. And that is shareholders' equity divided by the shares outstanding that they've issued to individuals like you and me. So today we're going to get into the income statement, or also known as the consolidated statement of operations, which just means income statement. And I use the colloquial term, I prefer that, or earnings statement. And let's continue with Apple. And so the first part of an income statement is how much money has a company brought in through its sales. So it's known as revenues or net sales. And the net sales for Apple a couple of years ago was $60 billion in the quarter I was looking at. So every 3 months, the company reports how much money they made by reporting in an income statement or consolidated operations. I'll just go forward, talk about income statement, say income statement. So Apple's revenues were 60.1 billion, and 60 billion of that was from sales, and 0.1 was 100 million was from the investments that we talked about there, cash and short-term investments. So almost all of their revenues comes from selling products. So on the income statement, there's revenues and then there's expenses. So the expenses for Apple were 47 billion, and almost all of that came from their cost of selling their products, meaning they have to produce those products. They buy the parts from vendors. So that was 37 of the 47 billion. Then there's research and development expenses, and there's commissions. They may have to pay their salespeople, and maybe they have their salespeople on salaries in the stores that they're in. So those each amounted to another 5 billion each. And so that's how we got to the 47 billion. So if we take 47 billion from the 60, that's 13 billion. If you take out taxes, which were about 2 billion, you get 11 billion. So in the quarter, on the income statement, you would find in this quarter that we're looking at, Apple earned $11 billion in one quarter. So that's a lot of money.
Good. I think we should do that, Joel. Well, how's that sound? Let's figure that out, can't we? Good for Apple. But Apple is a company that everybody in the world, right, is so familiar with that brand, right? So to break that down in that way, that's fascinating to think of it that way. So in a 3-month span, they earned $11 billion.
And this was 2 years ago. So if we look at
so who knows what it is
sure
today, right?
We'll find that it might be as much as double that. But even if so, you annualize that. Annualize means just multiply by 4, because that was one quarter, one fourth of a year, and we multiply by 4. 4 times 1/4 is 1. And so if you just annualize that 11 billion and multiply by 4, you get 44 billion. If they were consistent with making that amount of money each quarter. So that's an income statement, and it's very important to understand that, because ultimately all I care about is how much is a company making today and how much are they going to make in the future. I don't care about the past. It's today and the future. And
so making, right? So it's the difference. So I have it sometimes when I'm having conversations with folks about business, is they think about making as like top line, and you're talking about making as the bottom line, right? So that 11 billion versus, you know what I mean? Because it's a huge difference between companies can be doing a ton of top line, but if they're not making money at the bottom line, then it doesn't do anybody any good.
Right. So like, think about like my business where I charge for my individual coaching, I charge for my membership, and I charge for my group courses, my online courses, and I charge for my books. And that's revenues, that's net sales. But I have expenses like marketing expenses, like the cost to upkeep my website, the different types of coaching courses I take, because I think everyone needs to learn and develop every year. So I take my own coaching courses every year. That's part of my business expense. Their travel expenses, their expenses when I go into Manhattan to travel locally and then travel globally, meeting with clients, or going on a trip where I'm meeting with somebody who could be a potential client. All that's an expense. And so ultimately I care about is how much money did my business make in 2023. Great if my revenues went up and doubled. Usually my expenses don't double when my revenues go up double, because I have a lot of fixed expenses, meaning that it's not variable. Like if I have 10 more coaching clients, it doesn't mean my expenses go up 10 times. It's a lot of my expenses are fixed. The website's fixed. The people I pay to do my website, the people I pay for my back end, the virtual assistants, all those are fixed. So yes, the bottom line, net income. So revenues minus expenses equals income, or net income. And that's the number I'm looking at, or earnings per share, which is net income divided by shares outstanding. So we'll get to that in more detail, but the income statement is most important. as well as the cash flow statement. So I do my own business on a cash basis. You know, if you're a public company, we already talked about generally accepted accounting principles and accounting for the book value last time. But cash flow, cash is king. At the end of the day, if you can't translate that net income into cash, how are you going to pay your employees? How are you going to pay your vendors? So I also look at the cash flow statement. And as an insurance analyst, I want to see if, you know, there's a major hurricane, you know, and they have to pay out, the insurance company has to pay out 10 or 15 billion dollars. How do they do that? Do they have to sell investments? Or is their cash flow that they're generating each quarter enough to cover a big catastrophe? And so I'm looking at the cash flow from operations. And so we just talked about revenues minus expenses on the income statement, but you can look at cash revenues minus cash expenses. So what's the difference? The difference is, say Apple sells an iPhone and it's $1,000. And you have an agreement with Verizon or AT&T or T-Mobile, and you're paying $100 a month for the next 10 months. Well, let's say it's $50 a month for the next 20 months. So Apple's not getting $1,000. So on a cash basis, if we were to look at 2023 and say it's September, so we have September, October, November, December. On a cash basis, we paid $50 a month to Apple. That's $200. So on a cash basis, they made $200. On an accounting basis, they got the full $1,000. So that's the difference between cash accounting and this generally accepted accounting principle accounting, which matches expenses and revenues. That's the purpose of GAAP accounting. Anyway, don't need to go into accounting in detail, but the point is I like to look at cash. So what is cash revenues minus cash expenses? And for Apple, we just saw that on the balance sheet, on the income statement, net income is 11 billion. On the cash statement, it's 16 billion revenues minus expenses. So they actually had more revenues minus expenses than the income statement, which is good news. I like to see that. So
does that happen very often, or is that just an anomaly?
It doesn't happen very often.
Okay.
And so it's good news, which means that they have more cash to pay for expenses and for unforeseen items than on a GAAP basis. And so it's important to, that's why it's important to look at the cash statement too. And that's readily available on the press release on the website, as we talked about last time. You know, going to the company's website to get this information is a balance sheet, an income statement, and the cash statement.
Okay.
Now, there's one particular item that a lot of professional analysts use to approximate cash. So you can do this in between the quarters. If you're looking for a year, you can do it to estimate the cash for the year, and it's called EBITDA. And EBITDA is earnings before interest, taxes, depreciation, and amortization. And we don't need to go into all that, but it's a way to approximate cash. And so I just wanted to throw that term out there because a lot of investors look at a measure of some value compared to EBITDA. And so knowing at least that it's just an approximation to cash. That's all you need to know when you see the term EBITDA, or sometimes it's just EBIT if the company doesn't have anything to depreciate, like they don't have property to depreciate or real estate to depreciate, or they don't have an asset to amortize. So EBITDA is a term to approximate cash. So let's get into valuation ratios. This is the fun part because now we're getting into how a company is valued, right? So book value, we already talked about it. We mentioned last time. So book value equals equity, shareholders' equity divided by the shares outstanding. And I want to be clear here, because sometimes when I start talking about valuation ratios, some of my clients' eyes start rolling. And I say to them, look, did you get through 4th or 5th grade math? Did you learn how to subtract, add, multiply, and divide? Because that's all you
I
need
did
to
that.
do.
I was able to do all that. So yeah,
Right.
we're in a good spot.
So if you can add, subtract, multiply, and divide, and one of my clients said to me, you're bringing back memories of me being with my dad on the kitchen table and him like, and I'm like, get out your calculator. I mean, your calculator's on your phone now,
Yeah,
right?
no
I
doubt.
mean,
Yeah.
like
Pull out
get
your
out
phone.
your calculator. You don't need to get out a pad of paper. You need to divide 2 numbers. So if you can get out your calculator and divide 2 numbers, you can do these valuation metrics. So book value is the shareholders' equity divided by the shares outstanding. So we found last time that the book value for Apple was about 72 billion.
Mm-hmm.
So the shares outstanding, again, it will either be on the income statement or the balance sheet, depending on the company, how they report, but it'll be right there. It'll say number of shares outstanding or shares outstanding, or O/S for outstanding shares. Apple had about 17 billion shares outstanding. Okay. So if we just divide the 72, and I'm going to get out my calculator here and divide 72 by 17, we get $4.23. So that's the accounting measure of what the balance sheet is saying that Apple's worth, just $4.23. So that's interesting.
That is interesting.
It's interesting because I think most people know that Apple's not trading at around $4.23.
Not the last thing I heard anyways. Yeah.
And this was a couple of years ago. So even if you were to double or triple that because of the growth in the book value, the shareholders' equity, you would get $8 or $12. Well, I'm pretty sure, and I haven't looked in a while. I don't spend my days looking at Apple because I don't invest in Apple, but I'm pretty sure it's not at $8 or $12. So, but that's the accounting measure. That's what the accountants will say Apple's worth. And so that's book value. So let's look at earnings. Now, earnings, or EPS, I've actually used that term a few times already in these last 2 episodes. EPS is earnings per share. So to calculate earnings per share, we will take the net income divided by the number of shares outstanding. Now, it's a little bit different for net income or earnings per share versus book value, because the book value is done at the end of the quarter or the end of the year, and the earnings per share calculation is done throughout the quarter, throughout the year, because you earn the money throughout the quarter. It's not just a point in time. So we take the average outstanding shares for the quarter or for the year versus just the point in time that we did to calculate book value. So it's a slightly different number, but it's pretty similar. It's 17 billion, still 17.4 billion. So we just went through how much Apple earned in this quarter. In this example, they earned about 11 billion, if you remember that number. So 11 billion divided by about 17 billion. Let me do the calculation quickly here. 11 divided by 17. You guys can get out your calculator and do it yourselves. It's about 65 cents, 0.65. So in that quarter, a couple of years ago, Apple earned 65 cents
Per share.
So it doesn't sound like a lot, because if you multiply by 4, you get $2.58.8 or 59 cents, $2.59. So if say, I don't know what it's trading or what it was trading then, but let's say it was trading at 100. So 100 divided by $2.59. Now I'm getting ahead of myself, but that would be the price divided by the earnings. It's about 40, and we can calculate it exactly. 100 divided by 2.588 is 38.6 times. So that is the price to earnings, or EPS ratio. And so let's do this. So let's continue with this along this path. So if Apple did earn that same amount consistently, that 65 cents each quarter. So that particular quarter I looked at was low, but let's say it was earning 65 cents a quarter for 4 quarters. That was what we say $2.59. Okay. And so the price to earnings is about 40 times, just under 40 times. So you're paying 40 times their earnings when you buy the stock at $100. And what that says to me is, if you're paying 40 times, you believe that the earnings are going to grow 40% forever.
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 Let's emphasize that last part. Forever.
Forever. So, and Apple has grown more than that some quarters. But what you're saying is the price to earnings should be equal to the earnings per share growth forever, right? So basically, the $2. If we look at it this way, the $2. If Apple was paying out 100% of their earnings as a dividend, and we'll get into what a dividend means in a second, but if Apple was to pay out all their money to you, the $2.59, you own 1 share, $2.59 to you, right, for the year. They pay that to you every single year, $2.59 forever, right? If they're not growing at all, it would take 40 years for you to get paid the $100 that you paid for that stock.
Just to get your money back. It would take 40 years to get that initial investment.
40 years to get your money back. Right. So that's a long time.
That's forever.
Right. So
that's where it's determining whether something is expensive or in line cheap. Or cheap, right? Either right. Or, right? That's where that ratio comes in and is very valuable to know.
So that all that's doing is looking at current quarter's earnings. Now, there's many ways to calculate the PE, and let's just go through all of those right now, because it can be very confusing. So the PE is quoted all the time: price to earnings, price to earnings, price to earnings, P for price, E for earnings, or earnings per share. So what we did was just calculate the quarter's earnings and multiply it by 4, annualizing it to get the full year's earnings, and dividing the price by the earnings, right? So what most people do is not that. What they do is they add up all the past quarters, add up the past 4 quarters. So the past 4 quarters in my example was actually, it was 65 cents, 64 cents, $1.25, and 76 cents. So that's $3.30. So if we take 100 and divide by $3.30, we get 30. So the P is a little bit lower if we looked at the last 4 quarters. So it was 30 versus about 39 or 40.
And you said that's what most people do it that way? Is that what you said? Okay.
What I do is look at,
because that's what's most important, right? That's exactly trying to figure out exactly how you ran yours. Yeah. So what exactly did you do?
What I do is, well, when I was a professional investor, I would calculate the future earnings of the company. I had models. I checked. Now, there are professional analysts who have their own models who calculate the earnings as well. And as an individual investor, you have access to this information, not on the company's website, but on Yahoo Finance or on your Schwab or on your Vanguard or Fidelity account. It'll tell you the next 4 quarters worth of earnings or next year. I look at the next year, full year. So we're currently in 2023. I would look at 2024 Apple's earnings.
Estimated, correct?
Estimated by the professional analyst. Now, there are probably 30 analysts who cover Apple.
Okay.
And for the large companies, there are many analysts. So you take the average of all of them. Now, some of them may say, oh, they're going to earn $3. Some may say $5, some may say $6, but you're taking the average. And so usually if you have enough numbers, the average is pretty good. You can look at the highest and the lowest, but I look at the average. And so let's say Apple was going to earn $5 next year. That's pretty good growth, right? Because we just said $3.30. That would be about 50% growth. So if they were to grow 50%, they would earn $5 next year. And if I took the $100 stock price and divide by 5, then I only get 20. 20 looks a lot better than 30 or 39 or 40. And so what I do is I look at next year's earnings and add and use the analyst estimate, because I'm not modeling out all these companies anymore. And so it gives me a pretty good idea. The analysts are going to be wrong. They may be wrong by 10%. They're not going to be wrong by 100%. So if the average was $5, maybe they might earn $5.20 or $5.50 or $4.50. They're not going to earn $10 next year if the average is 5. And then unless there's some major catastrophe, or there's some, crazy bubble that happens or something very strange, it's very rare that the analysts are off by that much. It may be off by 10% or 5%, but not 100%. So that's what I do, is look at the price to earn the future earnings to get a sense. And then I compare that to and we'll get into my 5-step stock screen. This is actually step 4. We'll compare the future earnings for the next year versus the price compared to how much they've grown recently. And that's a really good indicator, is the company. So now we're not only doing the PE, but now we're comparing the company to its earnings growth. And now we have 2 different measures, and we're comparing the 2 together. If you just look at PE and say Apple's at 40 or 20, you need to compare it to something. What was Apple's average PE over the last 5 years or 10 years? Is 40 high or low? You don't really know unless you know history. Or the other way to look at PE is to compare it to their peers. So what's Amazon's PE this quarter? What's Google's? What's Samsung? What's the other competitors? And is Apple higher or lower than them? So those are the 2 ways I look at PE. I compare the company's PE to itself over time, and I compare it to its peers. And so all of this, ultimately, what we're trying to do is find a company that's inexpensive, that puts the odds in your favor so that you will succeed and earn more than the average 10% that you would get in an index fund.
And it's about accumulating all this information, right? And then taking this information and applying it to different companies, running it through the different models that you're mentioning, right? And then just coming up with the data. Let the numbers tell you the story.
Sure.
It's not necessarily, you don't want to fall in love with Apple. I'm an Apple user as well, but it doesn't matter. It's all about what the number will tell you at the end of the day, and keeping the emotions out of it, right? It's just an estimation based on what you're predicting for the future earnings of that company. Is that what I'm understanding?
Absolutely. And emotions are really important to talk about for a second here, because the whole point of this is to make it a formula and a process. So you can say, and write down your process and what you're going to do, your plan and goal before you invest. So you might say, look, I want to earn 50% or 100%, and I'm gonna get out if I lose 10%. and you have that in your notes, and you have the piece of paper up and alerts in your Schwab account or Fidelity Vanguard account. And so if it goes down 10% and that's your plan, you get out and you don't lose more than 10%. Or if you're, say Apple's at 100 and you say, okay, my target is 200. At 200, you sell no matter what. You don't say, oh, it's done. It looks like it's going straight up. I'm going to hold to 250. No, you stick with the plan. That's the whole point of this. And the whole point is to get the emotion out, right? You don't want to there's greed and there's fear. And you don't want to get too greedy or too fearful.
It's all about the mindset, right? Which we talk about that all the time as well.
All back to mindset. All back to mindset.
All back to mindset. Well, Joel, this has been super valuable. Is there anything to kind of put a bow on this episode here today anything else that you want to kind of share here towards the end, or should we wrap it up? I think this is a great stopping point to get to the next episode.
This is a great stopping point. And, valuation metrics are really important. We'll get into a lot more valuation metrics in the next episode. So stay tuned for that. And again, I just want to point out, people, if anything feels a little overwhelming, I'm here. If you want to take 30 minutes with me, I give 30 minutes free prosperity coaching to anyone. If you're listening to this and you're like, oh, wow, this is a lot, jump on a call with me. I'll ease your concerns, because I don't want this to be overwhelming. I want this to be really simple. I want you to become financially free. And if you're interested and passionate about stocks, this is the way to do it.
So tell where can they get that call with you? Where's the place for them to go?
Yeah, so you can go to salamour.com. I think it's over here, SALAURMOR.com. Right on the homepage, you can sign up for your free 30-minute prosperity coaching session. It may take a week or two, but I make myself available for you.
And I'll make sure we have that in the show notes for you folks as well, for those of you that are catching this outside of video, where you can see that on his screen. So, Joel, I really appreciate this time. I knew this was going to be so much fun. It's like I'm learning as we go. So I'm over here just kind of nodding and agreeing. It's like I'm taking it all in. I'm so excited about what we're going to learn next as we keep learning. As I've shared in the past, I've been fascinated with stocks, but I've never really gotten into it to this depth of information at this point. So far, this has been a lot of fun, and I look forward to the next episode in the series of the stocks, right? Going down the financial education with the stocks. So I appreciate you being here for sure.
Thanks so much for having me, Randy. Appreciate you.
Absolutely. So folks, go out there, take Joel up on his invitation, join him, go to salamour.com, his website, sign up for his 30-minute consultation. It will be so valuable to you that definitely take him up on that. He also has different resources on his website as well. You can grab any of it. He's on YouTube. He's in all the socials, right? Follow Joel. You'll be very happy that you did. And until we come back to you the next time in the next episode of this series, I hope everybody has a fantastic day, and leave us some feedback, right? That's kind of how we're going to know whether or not this is resonating with you. If you like this so far, let us know. Leave us some comments. I will be posting it not just in podcast form, but it'll be on YouTube. It'll be on all the different socials. Wherever you're listening to this, leave us some information, some feedback. If you're liking this so far, let us know, because that'll encourage us to continue on this journey of learning more about the stock market and how to pick stocks to be winners versus losing and falling behind. So go out there, make it a fantastic day. And until the next episode, bye now.